Hi, Michael Stokes here at the Financial Coaching Group. Today is session number 3 as we talk about the 4 myths. Myth number 3 is this: market timing. In other words, what is market timing? An attempt to alter or change the mix of assets based on a prediction or forecast about the future. In other words, when to get in, when to get out, when to get back in, and when to get back out again. And I'll show you in just a second what the industry has done to say don't get back in and get back out, and what we call tactical asset allocation. I'll show you that in just a second. But first of all, here's the myth. Money managers are able to utilize market timing to effectively predict the up and down markets. Okay? As we go forward here, Dalbar, which is the largest independent research firm located in the Boston area, actually studies investor behavior habits. They took a period of time and what they wanted to do from 87 to 2008, and they showed investor habits. During that period of time, the index, the S&P 500 index, did 8.64%. The average equity fund investor only did 1.87%. The systematic equity fund investor did 2.70%, but the market timer equity fund investor, the person that was trying to get in and out of the market or do anything like that, did a negative 0.83%. Inflation during that same period of time did 2.98%. So when we look at that, what we want to do is let's look at one little statistic that's very, very important. You hear a little bit about it, but it's really not well known. If we were to go back and look from this period of time from 96 to 2006, there's actually 2,500 trading days during that period of time. Okay, let's look and see why a market timer doesn't want to do that. Okay, number one, if you were fully invested just in the S&P, the narrowly S&P large cap index, S&P 500, you would have done 8.33% during that period of time. Your $10,000 investment would have grown to $22,252. Now, if you just missed the 10 best days of the 2,500 trading days during that period of time, your rate of return just dropped to 3.32%, or only $13,864 in your account. Missed the 20 days, you're almost at zero. Missed 30 days, you're actually negative at negative 3.71%. You have less money than you invested. 40 days, and you can see 60 days, you almost did negative 11% because you decided, hey, it's a great time to be out of the market, and you missed the 60 best days. Folks, no one knows when it's the best time to be in the market or it's the best time to be out of the market. No one can consistently predict that. What's the story here? Well, the industry says, hey, instead of being fully in the market or fully out of the market, let's just do this. Let's just kind of set up asset allocations, and we'll tell you what allocation to be in or what asset category to be in. Again, it's all disguised in the same thing as market timing. Be here in this category, be here in this category. It doesn't work. True diversification is being a global investor and staying the course and being invested in all asset categories. Okay? The moral of the story is this. Dr. Ellis, who is just a renowned brain when it comes to things, and he studied asset allocation, said the evidence on investors' managers' ability, success with market timing is impressively and overwhelmingly negative. Obviously, someone that's been studying this for a long time understands that you cannot asset allocate and time the market that way as well. Okay, next time I come back, what I'm going to do is talk to you about the 4th one, which is the cost of investing. This is Michael Stokes at the Financial Coaching Group. Have a great afternoon.